it's a feeding frenzy for low vol this year. I call it a craze. Everybody's piling in. It's probably the trade of the year. And guess what? This is the best performing of the lot, although not the most popular. 56 million, decent. 29 bips is a little high for a low vol, but very low for an actively managed low vol. That's what this is. It's actively managed. They use fundamental stock picking to reduce the volatility. Let's look at this versus the big dogs, SPLV and USMV. It is more like USMV in that it's sector constrained. So that's why you're going to have tech as the highest holding, more like a regular index. SPLV just goes for the lowest vol, then you get utilities and staples. So it's more like USMV in a way, but active. Now let's look at the performance of it versus these three, and you can see it's kind of got an edge on all three. And the reason for that is because it does have a little extra tech. And tech, even though it doesn't seem like it, is one of the best performing sectors this year, above and beyond utilities, staples, and other sectors. So that's giving it the edge. The question, Scarlet, is it low vol? And the answer is it's going to be a little higher vol than USMV and SPLV, but lower than the S&P.
Yeah, because of that tech exposure. All right, still with us is David Mann of Franklin Templeton, and clearly, as Eric showed us, you've got the performance, but this is a crowded space. Almost 24 low volatility or minimum volatility ETFs in the U.S. How do you distinguish your fund? How do you make it distinct?
Sure. And first, congrats on the 100th episode.
Thank you.
Very exciting. So Eric said it right. It all starts with leveraging the active expertise at Franklin Templeton, leaning on finding the fundamental, leveraging the fundamentals, using the research of the Franklin Equity Group. And what's interesting is low volatility is sometimes a volatile factor in and of itself. So even though this is a low volatility fund, even though we screen for volatility, it starts with picking the right stocks and then using that to make a more long-term evergreen product, which we think is better as a core holding.
So I'm glad you make that point, because there's a note from David Costin of Goldman Sachs about how investors tend to flock to the wrong low-vol stocks. He found there's frequent turnover in the low-vol group, so owning shares with the stablest earnings growth is a better way to play it than those with muted price swings. In other words, few companies can be relied upon for sustaining these muted price swings. Do you agree with that?
So I think that's an interesting point. I mean, the investors are going to low vol because they probably want to have some sort of upside downside capture, and they maybe are concerned what's going on with the marketplace. There's some level of I want to stay invested, but I want to take a little bit of risk off the table. And so one of the things that we think is interesting is the volatility factor is very volatile at times, and it can outperform one year, it can underperform other years. And so we think starting with the high quality stocks, leveraging the fundamentals, and then screening for volatility will just lead to that smoother ride over time.
You've got FLLV, and you've also got an outperforming high yield ETF, FLHY, beating HYG. So I have a question. How much of these products are you going to your mutual fund active managers? Because most people know Franklin as an active mutual fund shop. How much is it their brain power in these products versus your sort of own ETF area?
Sure. So, at Franklin Templeton, we have active, we have smart beta, we have passive. We just crossed the 5 billion mark. So for the passives, they're going to track an index. For the other two, we're leveraging the entire breadth of the firm and their active expertise. And to your point, when we have active funds, we are going to the same active managers that run a lot of the mutual funds that are going to date, finding gaps in our lineup that we think would make sense in the ETF form, and then leveraging all of that expertise. And
then real quick, ETF rule is out. You've told me you're a big fan of it. Why?
We think that now that as time goes on and as investors say, okay, what's the difference between an active and a passive fund? The ETF rule actually operationally says there's no difference between the two. And so as we continue having those conversations to say, hey, operationally there's no difference, all the liquidity, all the things that you love about ETFs actually apply whether there's an active or an index label on it, we think that will only open the doors more for ETFs going forward.